Welcome. I'm Beverly Goodman, and I'm joined by Tom Jessop, Head of Digital Assets for Fidelity Investments, which is probably the first and definitely a leader among financial services firms in really trying to understand blockchain, cryptocurrencies, and what the future might hold for all of us. Thanks so much for joining us, Tom.
Nice to be here, Beverly. Thanks for having me.
Sure. I am sure our audience is going to have a lot of questions. Please get them in early so we can address as many as possible. Let's start, though, with the premise of this session. How did we get here? A year ago, Bitcoin was still a punchline for a lot of people, especially in financial services. In the past few months, even, it seems like a lot of established money managers have gotten a lot more serious about facilitating Bitcoin ownership for themselves and their clients. Have we reached some sort of tipping point into acceptance or grudging acceptance? And if so, what happened?
Great question. Well, the short answer is yes, we have. I think as somebody who personally has been involved in the space for several years, I think we've reached a tipping point. I think you've had the accumulated experience of now roughly 12 years of the Bitcoin blockchain being operative since the Genesis block in early 2009. And the pandemic, quite frankly, was a catalyst for institutional adoption, and specifically Bitcoin and the narrative or use case around digital gold, particularly in an environment where we've seen unprecedented monetary and fiscal stimulus from central banks and governments in response to the pandemic. And I think what we've seen is you've seen an acceleration of institutions that were studying and evaluating the space who quickly moved to operationalizing it in that, call it macro context or backdrop. And we have not seen that demand or interest abate at all, given that we continue to operate in the same macro environment, if not one that's more expansive as we were a year ago when all this started.
So what do you anticipate coming next? Or is this, Bitcoin in terms of price and I think acceptance is kind of like leapt and then plateaued and leapt and plateaued. Do you see sort of, especially financial services, but the corporate world in general, on a straight trajectory towards embracing it and using it more and more? Or do you think once we kind of get back to normal after the pandemic, things will go back to normal?
It's an interesting question. I think we continue to see adoption at an accelerated pace. For a host of reasons, I think most market observers would suggest that we're not going to get out of this called stimulated environment anytime soon. Particularly from a portfolio standpoint, you look at the impact of interest rates on what was traditionally the 40% in a 60-40 portfolio, and the fact that there really aren't a lot of good options for folks to generate returns or yield in that traditional construct. I think that's also captured a lot of interest from investors. So I don't think it's going to abate anytime soon. I will also state that there's an interesting dynamic going on here where we know what the supply of Bitcoin is today, and it's a deterministic supply. We know what it will be 5 years from now, 10 years from now, 50 years from now. And that's fairly unique as far as financial assets are concerned. At the same time, we still don't know what the demand function is for the asset class. While we've seen a real acceleration of demand, I think most market observers would say we're still in the very early innings, or perhaps moving out of the early adopter phase into later, more majority phases of adoption. And I think it's really that demand function against that fixed supply function, which will determine where the price of the asset goes over the medium term.
Let's talk a little bit about Fidelity's work with Bitcoin. You've definitely been at the forefront of all of this. How did the interest start, and how have you experimented with it? Tell us what you've learned.
Yeah, so Fidelity has a real commitment to basic R&D in the technology space, which as a recent newcomer to Fidelity, I was really quite encouraged to see. Now we're looking at things like quantum computing. Before 5 years ago, we were looking at blockchain. And I think our hypothesis then was that it's a new operating system for financial services. It is a way to potentially move value around the planet more efficiently on a more automated basis with certain types of features that would not be possible in a more traditional framework. And that was really how we started looking at the technology. I don't think we had a native view on Bitcoin versus other assets, but we felt very strong that the technology was an enabler. And we began mining Bitcoin. We ran interesting experiments in the company cafeteria, allowing employees to buy food with Bitcoin for a whole list of reasons. My guess is those weren't very successful given the propensity of Bitcoin owners to want to hold the asset and not spend it. But it really gave us a sense of what the art of the possible was for the asset class and for the technology. And we still believe that while Bitcoin is effectively the gateway to this new technology world, we think there are a much broader set of use cases and value drivers over the long term for the technology.
Yeah, that Bitcoin in the cafeteria story is legendary. I love that one. What about your work beyond Bitcoin? You've talked a lot about the sort of the technology behind cryptocurrency. What else are you doing there? I think you have a blockchain incubator. You've been working on open source protocols. Tell us a little more about the technology aspect of it.
We do. So we that initial R&D effort that gave birth to the business that we now have at Fidelity still continues and is looking at a number of things. You know, we have folks in that what's called the Fidelity Center for Applied Technology that are thinking about ways to contribute to the open source projects around Bitcoin specifically to help make the protocols more secure. We as an organization fund independent research and programs to improve the technology and make it more fit for purpose and resilient. We are looking at enterprise uses for blockchain technology. So not so much native digital assets, but how can the technology make the movement of existing assets or the settlement of those assets more secure and more efficient by using this modern financial technology. And those developments will increasingly inform our commercial agenda in terms of how we think about bringing some of these capabilities to our clients.
So we've got a couple of great questions already. Michael wants to know, how can we be assured that the supply of Bitcoin is actually limited, and what's to stop someone from creating new Bitcoin and diluting the market? Maybe you can also talk a little bit about some of the other cryptocurrencies here too.
Sure. So the first thing I would say is that the different protocols have different what are called inflation rates or issuance rates in terms of whether the supply of tokens is capped or uncapped, and that really depends on the actual blockchain. In the case of the Bitcoin blockchain, this concept of 21 million Bitcoin is codified into the protocol. And when you think about the computing power, the mining power effectively that's used to validate transactions on the network, it would require a coordinated effort to effectively take the network over to change that issuance algorithm or protocol. And doing so would be extremely expensive, both in time and dollar terms. So most market observers would say that it's highly unlikely that that would happen. But again, there are other protocols that do not have capped supply. And it's one of the reasons why Bitcoin is seen as being digital gold or an aspirational store of value where perhaps other digital assets may not be.
So another question from Douglas is, are there any examples of institutions actually using a cryptocurrency? And how does their actual use affect the price of the underlying currency? So the answer to the first question is obviously yes, many. Maybe you can give some examples and talk a little bit about the price effect.
Yeah, so I think this idea of using Bitcoin as a means of payment or means of exchange has probably waxed and waned over the years. I think initially there were some early experiments from e-commerce companies to offer to accept Bitcoin in payment for goods and services. But the fact of the matter is that the predominant narrative now is around digital gold, and therefore investors are reluctant to spend it. So this idea of using Bitcoin as a means of payment, I think, has probably gone off the boil a little bit. Having said that, if you look at network activity and you actually look at the use of Bitcoin as a means of exchange, you do tend to see fairly steady growth trends on the network. And you tend to see them in economies or parts of the world where maybe the existing fiat currency is somewhat unstable, or you're in a hyperinflationary environment where, ironically, Bitcoin could be seen as a more stable value asset and means of exchange. But I think we're still very early days in terms of getting to that, getting back to what the initial premise of Bitcoin was, which was a peer-to-peer, monetary system.
Yeah, and just to follow up a couple of those examples, Tesla very famously invested in Bitcoin, and supposedly they're accepting Bitcoin payment for their cars. Square, Tom, as you noted, is another one of those sort of payment processors that's been experimenting with it. So it's definitely interesting to see whether it'll kind of be able to fulfill both functions, as you said, like the store of value like gold and a payment.
That's right.
Yeah, let's talk a little bit about a new endeavor you guys have. You've joined with Coinbase and Square to form a lobbying group to kind of work with regulators about how they should think about cryptocurrency. What do you think needs to be done at that level? Like, what do regulators need to understand about crypto?
Yeah, it's a great question. I would say that we've seen good regulatory progress in the U.S. I won't bore you with the specific details, but as far back as the middle of last year, the OCC, predominant bank regulator, providing guidance to banks that wanted to interact in the space was positive. The SEC has been moving in a positive direction. I think that what we need to do as an industry is really focus as much, if not more, on what are the policy implications, what are the enabling aspects of the technology for American consumers and businesses. And I think sometimes that story's been lost, in the broader context of enforcement actions and other things. But it is an enabling technology. I'm sort of old enough to remember this, but my touchstone is that back in the 90s, when the internet started to gain in prominence, Congress was very foot forward in passing legislation that would give e-commerce companies certain incentives or tax breaks at a state level to make sure that the technology could grow and propagate. Now, I'm not suggesting the industry needs those types of breaks. What I am saying is I think if we look at this technology from a policy standpoint, both in terms of what it does for financial inclusion, broader access to financial assets, and quite frankly, even some geopolitical considerations, given that countries like China have been very aggressive around rolling out central bank digital currency and using blockchain for industrial purposes, it really is bringing that type of perspective to policymakers, as well as education. There's still a lot of debate about things like power consumption, use of blockchain for fraudulent activity. And I think what we want to do as an organization, as an industry, is bring light to those topics and engage with policymakers in a constructive way so we can make this a strategic technology for the US and other global jurisdictions.
So we're almost out of time, but we're getting a bunch of questions about regulation. So let me just sort of try to summarize Vinay and Mark and a few others. What do you think will happen and what should happen? I mean, you made the comparison to the early days of the internet, which was also supposed to be rife with criminal element, like Bitcoin users are often thought to be today. What can you point to anything specific in terms of like what might happen or what you think should happen?
Great question. So look, any number of things. The Fed, for example, is looking at the efficacy of a central bank digital currency, a digital dollar. I think those are very constructive discussions, and the industry should be involved in those. I think that regulators like the SEC and CFTC, there's been a call, a few folks in Congress said, look, we want to create a working group that kind of unifies the SEC and the CFTC's approach to this asset class or this technology. That would be great. Harmonizing some of these regulations, it's also the case that depending on, the type of service you offer in the US, you have to deal with upwards of 50 state regulators. So anything we can do to harmonize some of the understanding about the technology and its uses, I think would go a long way in allowing the industry to continue to innovate on behalf of consumers and corporations in the US. So I don't have anything specific other than that type of engagement and focus on, constructive outcomes. We're looking forward to that type of engagement.
Well, thank you, Tom. Unfortunately, that is all the time. We could talk about this all day, I'm sure, but we've got some more great panels to get to. Thanks for joining us.
Thank you, Beverly.